Dalal Street saw its worst week in over 2 years. The Nifty and the Sensex fell over 4%, the biggest weekly fall since June of 2022. Except pharma, all sectoral indices have ended lower. And BSE companies, listed companies, have wiped out nearly 20 lakh crore rupees in investor wealth. We hate the sound of it, but that's what the market has done this week as the year is drawing to a close. The last couple of days left. Welcome to this week's edition of Editors Roundtable. We are going to decode the big fall that Dalal Street has seen. We'll talk about what some of the key reasons could be. And of course, one of those major reasons is global central bank action. So we'll talk about that, and also all about the electrifying gains that we've seen from electronics manufacturing stocks. And of course, what 2025 holds in store for sectors like cement and metals. Welcome to another edition of the Editors Roundtable. I'm Surabhi Upadhyay, and as you can see, with me here are Nigel, Prashant, and Nimesh.
Full team, actually.
What a week! And who would have thought? Yeah. As you know, we're in Christmas mood and all of that.
Absolutely, 1,000 points gone in 4 days. That's the kind of today was brutal, so to speak. Yeah. First signs of capitulation in the broader markets as well. Mid-cap index was down nearly 3%. A lot of damage is done in today's fall, especially in the broader market. So, yeah, I mean, I think everybody was trying to play a little smarter and was saying that by 25th we'll sell everything and then enjoy the last 1 week. I don't think market obliges that way, right? I mean, before anyone would think of, straight 1,000 points gone in just 4 trading sessions.
And these FPIs were supposed to be going on holiday from 15 December.
I don't know what's wrong with them. Every day they're selling 4,000 crores.
So the only big news event, I think you guys will agree, was the Fed, right?
Yeah.
But the point is, was this because of the Fed? Because coming into that Thursday morning, the Nifty had lost about 750 points from the highs. So it was minus 750 and then another 700 odd points after that over the last 2 days, today and Thursday included. So the sell-off had started before in that sense. I mean, prices lead and then reasons follow, as they say. And I think something like that has happened.
Yeah, and from a market commentary perspective as well, it became very difficult because we tend to talk about Santa, but Santa was making a quick entry and he was exiting also. Before you said it, like on Friday morning, Surabhi was saying, and Nigel, that Santa Claus rally is there and the market is up 100 points. And
Santa
before we ended, Santa had slipped out, exit stage left.
He left his red color behind. Plenty of red color on the screen.
Santa's out looking for snow. Poor guy. But it's been that kind of I think week, and it's been tough all around. But I think central bank, right? So it'll be something which, of course, started with Fed, but we had some Remo was telling me some 20-25 central bank actions.
Yeah, I think she had a really long list. I focused on only the 3-4 major ones. 22 was quite a handful for me. But just before we introduce our guest on the show, just a quick roundup of why this has been such an important week from the central bank perspective. Let's start with the Fed. Now, we all know 25 basis points was delivered, but the format of what they're saying about 2025. Now, the Fed was supposed to do 4 rate cuts in 2025. Suddenly, what are they saying? That no, we are going to do 2 rate cuts. Why is that? It's very simple. Growth in the US is looking very strong and inflation is proving to be sticky. The growth number, in fact, when we came in to trade on Friday, we had the final reading of the third quarter US GDP. And look at that number. It's so strong at 3.1%. So the GDP projections for the Fed itself are now much, much better. In its policy this week, the Fed acknowledged the fact that it's probably sort of miscalculated or underestimated the strength of the US economy. They were expecting 2% growth in 24. Now they're saying it's going to be 2.5%. And the estimates for next year are about 2.1%. Like I said, the third quarter GDP number is red hot at 3.1%. Now come to inflation. Inflation last couple of months has been anyway trending higher back in the US. 2.1% in September, 2.3% in October. And tonight, we are going to get the November PCE number, and the market is on the edge. A lot of the reason why we had a sell-off on Friday was that the market is very nervous about tonight's number, and it's expected to be again above the Fed's comfort zone of 2%. So that's the problem over there. Now, as a result, we saw the reaction playing out in asset classes. Yields have been shooting higher, almost 4.5% on the US 10-year. If you talk about the dollar index, it's at near 2-year highs. I mean, we're talking over 108 on the DXY. And that's playing out against a lot of currencies, the euro, Asian currencies like the rupee weakened to, of course, that level of 85 this week as well. Now let's move about the, and Wall Street, of course, kind of had to deal with the shock. It wasn't prepared for it. And the net result is a decline of anywhere between 2.5% to almost 3.5% on different US indices this week. So far this week, it's just 4 trading sessions, mind you. Now, on the other central banks, the Bank of Japan decided to hold its fire. Though it's dealing with sticky inflation, the BOJ did not cut rates. Inflation, by the way, in Japan is also trending higher. November inflation is 2.7% versus 2.3 in October. But the BOJ is saying, let's wait and watch. Let's see what happens once Donald Trump takes office, and then we'll decide. And finally, you had the BOE, which also for the time being didn't cut rates. So the other central banks are waiting and watching to assess what happens with the shift in Fed policy itself. But that was the big highlight. And I think the markets have taken their time to digest it, right, in terms of this new narrative that the Fed has very clearly now laid out.
Yeah. Absolutely. And I think let's actually take some of these points to Ashwini, who's with us, Ashwini Agarwal, founder and partner at Demeter Advisors. Ashwini, good to have you with us here. Thank you for joining us. So, you know, the retail part of the market is still hopeful because that's the way the market has worked. You know, things will work out. Market will move up. Expectations have never been at any point during corrections, etc., over the last 2 years that maybe this is going to be a sustained downward kind of thing. Now we're at the end of the year, starting into 25. What's the expectation and how will things work broadly, directionally from here?
Thanks for having me on the show. And Prashant, to answer your question, you know, whatever I'm going to say is not going to offer a lot of Christmas cheer. I think the issue is that, you know, on the one hand, you have the US markets playing the Pied Piper to global investor sentiment. And that's in a very dangerous situation to be because we have a political leadership change coming up there. And while the policies will change, we don't know how it's going to pan out because there are a lot of inconsistencies in you know, President Trump's proposals. Just for example, I mean, how do you deal with the fact that you'll have higher tariffs and yet you expect the inflation to be benign? I mean, how does that work? Or how do you curb immigration and you know, manage growth? Or for that matter, you cut taxes for corporates, but you keep the fiscal deficit lower. So, you know, nobody knows how it's going to pan out. So that's one part of the story. So the rally that we saw post the US US presidential election seemed to be now fading out. People are struggling with the inconsistencies that we have. And of course, the data that you pointed to in your opening remarks. That's one. Second, coming closer to India, I think what's very clear is that the paper supply now is getting to a point where it's not just absorbing all the retail inflows, but it's probably kind of eating into the cash reserves of the mutual funds as well. Now, you know, at some point, markets are all about demand and supply, and the supply is so overwhelming at this point in time that I don't see a way out unless for some reason we see a pullback in the supply of paper. Retail investors, you know, have had a very good run for 4 years, but in the interim, we did see a period between September 21 and say March 23 when the markets didn't go anywhere. And at that point in time, I think it was almost about 2 or 3 quarters of negative returns, after which the mutual fund inflows started to look softer. So you might see the strength in the flows continue in India, but I think from a sentiment perspective, I think things are starting to look a little more fragile.
Ashwini, I just want to take your point forward on the IPOs and the supply of paper. Given your experience of the last many decades, do you think this time, the IPO market, the very hot IPO market, that will give a sign of a bit of a capitulation or further pain coming in? Because, you know, we're not seeing that kind of correction in the IPO markets as well. You know, it's like easy money to be made every other day. People are making money in the IPO market by just flipping and trading. You think that will give a clear sign and a picture that, you know, hey, market is now giving you signs that time to be caution and time to be careful as well? You know,
just to, and that's a very important question, Nimesh. Just to add just one line to it, I remember Naren saying it, I think it was a presentation a year ago. He said, and he went back all the way to 94. He said the 94 bull market was ended because of market got overwhelmed with supply. With
the supply, correct.
So yeah, please go on.
Yeah. So thanks, Prashant. Thanks, Nimesh. It's always about demand and supply. So I still remember, you know, the first strategy report I had written back in 1994 as a research analyst. And some of the veterans in the market at that point said to me that, you know, fundamentals is one thing, but ultimately it's all about demand and supply. And I think the supply is starting to get overwhelming. Having said this, if you go back and see 2008 or you see 2000 or you see 1994, all those tops were made by some very large issuances at exorbitant prices, and suddenly the Pied Piper disappeared. You were no longer making listing gains. So we are not at that point yet. I mean, we are still making listing gains. So I think you need some large issue to kind of go belly up. I mean, that happened in 21, for instance. All the large tech platform companies, they kind of delivered negative returns 6 months into their listing. And that kind of broke the sentiment a little bit. So we haven't seen that yet. It may happen, who knows? But you have to see the signs of that for the IPO frenzy to fade. And that hasn't happened yet.
But also, folks, what we've also seen is that while there's frenzy in the supply of paper, but what type of paper? Majority of these IPOs are OFSs, right? It's very rare to see a company come out with fundraising, in which the company is, using it for growth capital. So that also, at some level, makes you a little nervous.
You know, what was the headline of this week in terms of the IPO headline? An SME IPO, 7 crore.
14,000 crores.
That's what.
2,000
times subscription. So I guess, what Ashwini said, we have not yet seen the valuation bubble in the IPO, but the frenziness, the kind of paper which is coming in.
All OFS, people checking out.
And by the way, MNCs, right? Today we spoke at Bazaar, we had Italian company, MNC listing here. The Italian parent is selling 30%. LG will come now.
PE selling, MNCs are selling, Indian promoters are selling.
Best place to list. Has been. Well, let's talk about one sector which has done phenomenally well. And this is, I think, you asked, we did that market town hall, the electronic manufacturing space came out as still an idea. And, at every point in the last 2-3 years, it looked like, well, bahut ho gaya. But bahut hi ho gaya. And Nimish, tell us.
So, Prashant, this is something not new, right? We've been discussing many a times about the EMS as a space, the kind of returns the stocks have given. I just wanted to revisit the space because, we're almost closing towards the year end, 25, again promising to be a good year, but the kind of returns the stocks have given is just mind-boggling, electrifying, as Prashant pointed out. So let me just go to the wall and explain as to what has EMS stocks done this year and maybe for the last couple of years. So that's the picture that we want to put out for EMS companies. Again, what you call is electronic manufacturing. This is the list of stocks and the kind of returns they've given 1 year and 2 years. So Y2D returns, Ember, Dixon, Avalon, Keynes, PG Electroplast, Sirma, and Sign DLM, 98%, 96%, 300% for something like PG Electroplast. But what is more interesting is the 2-year returns of these stocks. Ember is up 3x in the last 2 years. Dixon Technologies is up 5x in the last 2 years. Keynes Technologies, we all talk about the stock has done so well, Prashant. The stock is up 10x in the last 2 years. PG Electroplast recently raised money and still the stock is up 8.5 times. And at these levels, some bigger mutual funds are getting into this company. So that's the kind of growth they are expecting. Sirma and Signed have been 2x. So, I mean, it looked like, 2x is just underperformance given the 10x kind of returns we've seen there. So what's worked for this EMS companies? A couple of reasons why this companies have done really well. First is the PLI focus, the government's PLI focus. That's been a big incentive for all these companies. Second, a big thrust on incrementally, a lot of investments from the global OEMs is coming to India. Look at Oracle. They're talking about $75 billion of insourcing from India over the next 5-7 years. So that's the kind of focus which is there. And third, the government's focus and thrust to have a local value addition going up to 30-40% from current 15 to 18%. So that's the kind of localization which is going to see for these companies to benefit in the years to come. So that's the growth factor. Now, what is the road ahead for this company? We've seen a lot of the opportunities, but it's priced in as well. So just thought of putting out some highlight on what are the things to watch out for. The big debate is the higher valuations, but most believe that it can sustain given the kind of earnings momentum these companies are throwing up. Second, the revenue growth is going to be quite strong on the back of the strong order book that most of these companies have, and they're expecting even further orders to go up. So that's something. The third is in the very near term, this is something to track. The cabinet approval for the 40,000 crore additional PLI is likely to come very soon. That was part of a Nomura note, and we've been anticipating that this will come very soon. So that's something to track. And what are the stocks to watch out for? Of course, Dixon has been the leader of this pack. Most of them believe that Dixon could be one of the biggest beneficiaries, even from these levels, the kind of return we've seen. Still, they have the bandwidth to take it forward. In terms of other stocks to focus on and what are the triggers for them, let's look at Dixon. Of course, we talk about Dixon as that's the best placed company because of the manufacturing and the IT hardware benefit that they have. Keynes, again, while we all debate about valuation, stock is up 10x, but the kind of opportunities they're getting and the kind of orders they have, And again, now they're getting into different businesses as well. So that's going to help them. Same with Amber as well. Even they are diversifying into railways and other segments. So these are the companies which are now diversifying beyond the pure manufacturing opportunities as well. Now, the last thing on the valuations, you spoke about how much the stocks have gone up. I just want to run through the valuations of all these companies. Everybody is trading between 35 to 75 times on 1 year forward price to multiple. But in terms of revenue CAGR, the kind of opportunities they're going to throw or they're going to give between 24 and 26, this is the general estimates. Everybody is going to grow between 33%, 23% to all the way to 55, 60%. So the revenue growth is going to be quite strong. There is a big opportunity as far as India is concerned. But do keep in mind the fact that these stocks have rallied between 2 times to 10 times, and the valuations are not that cheap now for all those companies. So that's the EMS space. Been a electrifying rally we've seen in all the names in the last, say, 1 year as well as in 2 years. Ashwini, you're what on this space? Have you been part of this journey of making big money in the EMS stocks? And what's your view on valuations now?
Okay. So I haven't been a part of this rally. So, I've been lucky in other places, but this is a place that I've completely missed. And the sore point, which I'm going to highlight again, unfortunately, has been valuations. The starting point valuations for all these companies have always looked expensive. And yes, they've surprised positively on earnings, and valuations have continued to expand. So both those factors have kind of supported returns over the last couple of years. And the only lesson that keeps coming back to me time and again is that as an investor, the starting point of the valuation is a very important number for me. Because that's what protects you if your assumptions go wrong. We all know that future is uncertain, but if you buy a stock where a lot of the future is already baked in, then your downside risk can be quite high. I mean, we saw that in 2000 in IT services, for example. I mean, most of the companies went on to do a lot more than what we could imagine back in 99 and 2000. But the fact is that between 2000 and 2008, you didn't make money in most IT names. So, could this be again a situation where the companies actually continue to do very well, but you don't make money as an investor? So I think the margin of safety is not there, and that's a point that you also made. So I tend to agree with that.
Fair point. Fair point.
Okay, well, that's a very interesting data and interesting viewpoint as well. Let's take that quick commercial break here. We're going to come back and continue more specific conversations. Ashwini stays with us. See you in a jiffy.
Welcome back. Well, Ashwini, I wanted your view on a couple of sectors, cement as well as steel. They've had a rough 2024, but some part of the street is optimistic about 2025. Before we come to you, Ashwini, I just wanted to run our viewers through a couple of points. First, in this year, the biggest problem was Chinese exports. They hit the highest that we have seen in multiple years. In fact, it's the highest since 2016, more than 100 million tons. And India was suffering because imports went up. We had steel imports that jumped up drastically in this particular year itself. So it's been a big problem with regard to that. But the ministry is saying, your steel ministry is saying, give us some protection. And if that comes about, if we're talking about the 20% odd, then probably steel prices could get increased by around 2,000, 2,500 rupees odd. And as of now, at least, the domestic prices are a bit of a discount in comparison to the landed cost of steel. Can things get better from here on? That's the most important. Steel prices in China are likely to have bottomed out. You have exports as well that could fall from these elevated levels. And there is domestic capacity that's going to come on stream with focus on cost efficiency as well as on value-added products. And if you just pull up a chart, you'll see the kind of capacities that the street has planned. We'll see whether or not there is protection that's coming in there. Cement, it's been a forgettable year. Good amount of consolidation, but pricing, demand, very weak. Pricing is at the lowest we've seen in the last 4 years. Demand, you can blame it on the monsoon, on the winters, on the summers, but the demand has been very, very weak. And you have the state and central elections as well that have added some kind of a headwind to this kind of demand. But the street is optimistic. Goldman Sachs is saying FY26 will rebound in terms of demand. It should grow by close to around 7%. On profitability, both Incred as well as Access Capital, they say spreads are improving and EBITDA per ton as well should improve. So the question, Ashwini, is, will things improve from year on with regard to cement as well as steel? There is optimism, but will it become a reality? What's your take?
Nigel, on steel, the answer is very clear. If the government were to go ahead and impose a 25% import duty, as suggested in some of the newspaper reports, basis discussions that are apparently going on in the government, then obviously, steel stocks will do very well. Your EBITDA per ton will expand, and that will lead to, very solid earnings growth. The question I wonder sometimes is that desirable from an inflation perspective or from the cost of inputs for other industries? I'd be disappointed if import duties are put into place, even though there's some short-term dumping issue from China. But nevertheless, if the duty comes through, obviously, it'll be good for steel companies. On cement, again, I think the spreads are actually pretty decent, and spreads are not bad. And if the rural demand were to revive, because water reservoirs are pretty good and winter crop outlook appears to be pretty strong, if you see a revival in rural demand, then I think cement can also do a little bit better going ahead than it has done in the recent past. But cement is an industry which doesn't excite me as an investor. I mean, you can put up as much capacity as you wish. There's no shortage of limestone in this country. And, time and again, all of us who've tried to project supply have found that, supply has turned out to be a lot larger than what we had anticipated. So it's more of a demand situation that drives cement as opposed to lack of supply. So I think that's the point one has to bear in mind. So it might be a trading pop, but it's not really something that creates value in the long run.
Okay. All right. So that's on steel, on cement, some of those sectors. Ashwini, you tell us. While you were cautious on 2025 and you've said that it might not be a straight line, might not be a very charitable year, what is your best bet, money-making idea?
Thanks, Surbi. What I'm looking at are some of the sectors that have been out of favor this year. Consumers, for example, I think there's been a huge amount of correction, both in relative as well as in some in absolute terms in consumer names. So that's an area where I think, I see some stocks which are starting to look fairly attractive on a bottom-up basis. Some of these are in the staples space. I also see specialty chemicals and a lot of the other large chemicals, including agrochemicals. There, I think both the end product demand as well as margins should normalize going ahead. So, this is an area where we saw that COVID boom and the post-COVID bust. And I think pretty much all the bad news is behind us. And the third one, which is a little more difficult to call, honestly, is financials. Financials have been in the doghouse all of 2024. Barring a couple of names. And I think both on the asset quality front and on the growth front, news is going to be incrementally better. In financials, however, I worry about the role of fintechs and how agile and nimble they've become and their ability to eat away at some of the core business of the bank. So the large banks, leave me a little bit more lukewarm. But maybe the microfinance players turn around, maybe some of the fintechs start looking interesting. And there are some other lenders which are looking quite interesting. So it's a kind of a mix and match, more bottom up, but that's one area that I'm looking at.
Okay, all right. That leaves us with a fair amount of optimism and some ideas to work with. Ashwini, thank you very much for being with us on the show today. Wish you a fabulous end to 2024 and an even better 2025. Thank you for joining in. And with that, guys, it's a wrap.
Yeah, it's a wrap.
Absolutely, it's a wrap. Thank you very much for staying with us. We'll be back bright and early Monday morning and, of course, continue market coverage. But news and updates continue here on the other side.